Hey, I'm Melanie Badrovic. Today we're going to dive into the best financing options to fund your deals. So we know that rental properties are a great investment. We've gone over what types of properties to look for, how to find these great deals and buy them below market value, and analyze if they make a great rental property investment or not. Now we need to cover how are we going to finance our investment properties. In terms of expectations, you need to be ready to put down 20 to 30% for residential properties, especially if it's not your first real estate purchase, if you want to do it right. Just please be aware of all other options when you're putting down less than 20% on a real estate purchase. You first need to understand how putting less money down can impact your cash flow, but also how it's going to impede your ability to qualify for the next mortgage. About 15 years ago, you could get financing on an investment property with as little as 5% down and in some cases 0 down from a bank. Those days are gone for the most part, and it's much tougher to get financing on investment properties now. But having said that, it might not be as difficult to obtain loans on rental properties as some banks make it out to be. When I was buying rentals, many banks told me I couldn't get more than 4 mortgages in my name. That's just not true. What they meant to say is that their bank wouldn't give me more than 4 mortgages in my name. There's no law or government restrictions on how many mortgages you can have. One great way to increase cash flow and build wealth is by using leverage to buy more investment properties. There are ways to buy more properties with less cash, and if you buy the right properties, you can make even more money. And that's what we're going to go over. Knowing all of your options for financing will optimize your investment strategy. So let's go over the 7 options. We have liquid assets, aka cash. 2, conventional lending through a bank. 3, we can use private money. 4, hard money loans. 5, seller financing or vendor take-back. 6, equity from our real estate. And 7, joint venture partnerships. Let's start with number 1, liquid assets. This first option is obviously the most desirable one and the easiest. Liquid assets comprise of any money you have that's readily available in cash form or an investment that can be easily liquidated on short notice. Investments you might consider liquidating include stocks, bonds, and other investments that you feel would be better served liquidated and used towards a real estate investment purchase. Having your own capital is the strongest position to be in, as you don't have to borrow, you don't have to pay interest on, or take a partner to access. And it also makes you most attractive to the banks. So it's the best position to be in, but as you become a serious investor, you're going to see how quickly your money gets used up. So if you plan to buy more than 1 or 2 properties a year, you're going to need to look at different options for raising capital to keep your investment portfolio growing. Now, let's look at conventional lending. Through a bank is the most common form of financing most investors think of. Now, the main problem here are the hurdles that the average investor has to jump through just to get a loan on investment properties. First, you have to have good credit, which, let's be honest, not a lot of people do, especially since the last housing crash. Second, proof of income and assets for at least 1 year. In a lot of cases, it's for the last 2 or 3 years. And thirdly, property you're buying usually can't be a major fixer-upper. Lenders don't like to lend on these types of properties for the most part. Lastly, as we covered before, you're going to need at least a 15 to 25% down payment depending on the type of property. And even after all those requirements are met, you can still only qualify for a small number of loans in your own name. Every person has a lending limit to a conventional bank. If you're thinking about trying to get a conventional mortgage from a traditional bank, make sure you get a pre-approval for a specified mortgage amount before you write up an offer or put a property under contract. Having this pre-approval is a way for the seller to know that you're financially capable of closing the deal, and you'll also save yourself and your lender a lot of stress trying to firm everything up under really tight timelines. Conventional loans, which are usually fixed-rate mortgages, typically financed for 25 to 30 years, are the most popular type of financing. In a traditional scenario, a buyer financing with a conventional lender is going to put at least 20% down and have the other 80% financed. But buyers without 20% down will have to have mortgage insurance, which protects the lender in the event that the buyer, you, defaults on the loan. Now, with that being said, most lenders usually require investors to put at least 25% down, and in most cases more, since they're not occupying the residence, so therefore they're more at risk. Simply having the right amount of cash on hand for the down payment doesn't make you qualified for a loan. Remember, you also need to meet certain income criteria to be eligible for financing. Remember, as an investor, you're going to run into two problems at some point. Problem number one, you're going to have difficulty qualifying for a mortgage at the bank because of debt to income ratios. And number two, you're going to run out of money for down payments really quickly. As a novice investor, your banker primarily evaluates you and your ability to pay the mortgage. So your job is to provide the banker with the information in such a way that they feel comfortable saying yes. And as you move towards becoming a more sophisticated investor, and especially if you start investing in multifamily housing or apartment buildings, that goes into now commercial mortgages, which is something completely different. When we're dealing with commercial mortgages, the property becomes the focus and you become the secondary focus. The key here is a way to provide extensive due diligence to your banker. They're going to provide you with their specific checklist, and it's your job to impress your banker by not only giving them all that information, but also providing more. Now, in the event we can't get conventional mortgages, this is where we turn to private money. When all other options have been exhausted, you got to go to private lenders, which is definitely a more expensive alternative. But if you're unable to qualify at the bank, private money is a legitimate alternative and really worth considering. Private money is a more expensive alternative because interest rates for first mortgages range from 7 to 10%, and for second mortgages, the range can be between 12 and 14%. Once again, for self-employed individuals or business owners in their startup phase, there's much more flexibility in terms of income verification. Much like high ratio insured mortgages, all other options should be exhausted before considering a private lender. If a less expensive conventional loan isn't an option though, then private money can be invaluable to your business because it's going to allow you to keep your portfolio growing. And if you know that things will be changing with your financial situation soon, you can use this method for a short period of time until perhaps you're more suitable to qualify for a conventional mortgage with a traditional bank. If you use this strategy, you're going to receive the benefit of a much lower rate, and this will be great help with your cash flow position. You could find someone who knows less about real estate than you do, but still wants to profit from investing. It can come from someone's retirement account or syndicates, someone with a lot of cash. They will put up the loan in exchange for either profit participation or a fixed interest return. Private money is negotiable, remember, so you and the lender negotiate the terms of your agreement. As long as you can show the lender that your plan is to cash them out after roughly 6 months by doing a conventional rate and term refinance, you can use private money to get into rental properties and then use them again for your next purchase. Number 4, hard money loan. So hard money loans are accompanied by high interest and fees. These loans are a short-term, expensive option. Hard money loans are typically issued by private investors or companies. The benefit of getting financing through a hard money lender is that only the property value is taken into account for qualification. Unlike private money, the credit worthiness of the borrower isn't taken into account at all. This style of lending is purely asset-based, which is beneficial for those who don't have the best credit scores, are self-employed, or don't have high income. Since the property itself is used as the only protection against default by the borrower, hard money loans have a lower loan-to-value ratio than traditional loans do. They also carry interest rates even higher than traditional subprime loans. But since traditional lenders don't make hard money loans, hard loan lenders are sometimes private individuals or companies that see value in this type of potentially risky venture. Hard money loans are typically used in turnaround situations. They're really short-term financing. These loans are used by borrowers with poor credit but substantial equity in their property who wish to avoid foreclosure. On the road to growing your portfolio, a benefit of using hard money is that the money is received so quickly that it allows you to make quick purchasing decisions when needed. However, you should only use hard money if you have a fast exit strategy. Most hard money loans are used for projects lasting a few months to a few years at the very most. Unless you're flipping a house or applying for a new loan from a conventional lender in the near future, I wouldn't recommend using hard money loans. Number 5, let's talk about vendor takeback, or also known as seller financing. This is a great strategy, and it's going to be even more powerful in the coming years. Vendor takeback, also known again as seller financing, is essentially a second mortgage that's arranged by the vendor, the seller, in order to facilitate the purchase when the buyer doesn't have enough funds to close the deal. For example, let's say that you don't have the 20% to put down on a real estate purchase. So you're going to approach the seller, ask them if they would hold a second mortgage on the property. So the vendor can take back or grant you a portion of the down payment, usually around 10% in the form of a second mortgage. So let's do an example. If the purchase price is $150,000, you have $15,000, which would be 10%. You would arrange a first mortgage with a conventional lender for $120,000. That's 80% financing. But you're still going to be $15,000 short at this point. So this is when you ask the vendor to grant you the remaining $15,000 in the form of a second mortgage charged against the property. You then negotiate the interest rate you're going to pay the vendor on the $15,000. Usually, it would be a better rate than they would get by investing their money anywhere else, say around 7 to 10% rate of return. This situation works out nicely for them because their loan is secured against the property, making it a relatively safe investment. And they also have the ability to foreclose on you in the event that you default on your payments. Once they accept your offer, you close the deal. At that point, you're going to simultaneously make payments to your bank for the first mortgage, as well as to your seller for the second. In this example, you would have then purchased your property with only 10% down. This is a great strategy to use, and it would be in your best interest to educate the vendor on the benefits this option can bring them. Number 6, equity from real estate. So a percentage of money that you have in your principal residence or in other rental properties can be used to form part or all of your down payment on a rental property. A seasoned investor can calculate the accessible equity in their homes with the following equation. We're going to take the market value of your home, times it by 80%, and subtract your existing mortgage or line of credit. And that's going to tell you what your potential accessible equity is. We use 80% in this example because it's the conventional limit before the mortgage is considered high ratio and requires insurance. Now let me show you an example of this formula. Say the market value of your house is $200,000 and your outstanding mortgage is $100,000. So 80% of the market value is $160,000. So now we're going to subtract the $100,000 still owing on the mortgage, which gives you $60,000 in equity that you can pull out cash. I've done this a couple of times on my rental properties in order to come up with more down payments to purchase more properties. That's what's called refinancing. In my case, I was able to pull out $53,000 from one of my properties 5 years after I purchased it. I was then able to put that $53,000 down towards another rental property. So the market value of my house at the time was $230,000. My existing mortgage was $108,000. Now the bank would finance me up to 70% because it was an investment property, not my principal residence. So we take the market value times 70% minus my outstanding mortgage, and that gave me $53,000. I love how real estate constantly appreciates. It's one of the best benefits I think we get as investors, especially on single-family homes. Appreciation gives you access to serious cash over time. But always remember the cause and effect of your actions. Remember that any equity that's taken out of your rental properties will decrease your cash flow because your mortgage payments most likely are going to go up. So if, for instance, refinancing your property up to 80% creates negative cash flow, consider the option of only going to 65% or 75%. Another key point to remember when you're looking to do a refinance is that you still have to qualify at the bank to access that equity. So all the same rules still apply to acquiring a mortgage. And thirdly, if any equity is taken out of your principal residence, that will increase your personal consumer debt that's on your balance sheet. So I just want to make sure that you're aware of this before you're making your decisions. And as a rule of thumb, I advise that people don't access all of their potential equity for the purpose of creating seed capital, because you could leave yourself very vulnerable to market fluctuations and the danger of being in a negative cash flow position. Just understand the difference between what is in the world of possibilities and what is really fiscally responsible for you. Now, number 7, let's talk about joint venture partnerships. Setting up a joint venture money partnership works if you can find an investor with a lot of cash but little desire to do all the dirty work. There are many different forms of joint venture partnerships. However, in a nutshell, it means that the investor is the expert and does all the work to find the property, close the deal, and finds another party that's willing to invest funds into the property for a healthy return. The investor usually takes care of everything from finding the deals, negotiating and closing them, handling any renovations, or managing anything to do with the property, and the other party usually comes up with the down payment and the closing costs. Both parties go on title and they're responsible for the mortgage, and the joint venture agreement can be for any percentage you guys negotiate together, but a typical JV agreement would be splitting both the monthly cash flow and the net proceeds from a future sale 50-50. This option is the best solution for investors who have limited capital but really want to acquire many properties in their portfolio. There are unlimited opportunities for growth with this method if it's used properly. If you want help, more in-depth strategies on how to execute any of these financing strategies, please feel free to reach out to me at melaniebadjovic.com or sign up below to learn more how I can help you.